in 2000. So our principal's from Harvard. So
there you go. They're all right.
And is currently the chairman and managing member, of Great Hill Capital, and hedge dollars in the stock market for accredited investors and qualified institutions. Accredited investors is people that have lots of money. That's how that works. Okay. He regularly appears on television such as networks as Fox, Yahoo Business, Bloomberg, BBC, and others. He is regularly quoted in the Wall Street Journal, Barron's, Financial Times, Reuters, USA Today, and U.S. News and World Report. His podcast, videocast called Hedge Fund Tips with Thomas Hayes, runs weekly, and clips of it often appear in Mr. Snyder's Stat of the Day segments at the beginning of class. He's on X, Instagram, all that kind of stuff. He just moved to Huntington Beach, so we're going to welcome him. He lives in Huntington Beach. That's the bad side of town. Don't go over there. Oh, you were in Fox this morning. I didn't know that. Very good. So this is awesome. He loves to golf. That's the important golf. Love golf. Okay. Sometimes he might miss work because of golf. Okay, let's welcome Mr. Thomas Hayes.
All right, thank you. Wow. Well, that is a very warm welcome. It's wonderful to be here. Wonderful to be in Southern California. We bought a house a couple months ago. My daughters are very competitive water polo players, swimmers. Anyone here swim? No? Mostly just statistics in La Quinta. Swimmer over there, what's your stroke? All right. Which one? 150? 50 and 100. Good for you. Awesome. So I grew up in New Jersey, went to school in New York City. We have houses in Connecticut, and now we're residents of California. So really honored to be here. My wife came up with this crazy idea in September, and I said, well, if we're going to live in Southern California, we got to be able to see the beach from our house, and we got to be able to walk to the beach from our house. And we've been blessed to do that and meet some wonderful people along the way. So I'm going to go through a presentation, and I wish I had seen a presentation like this when I was your age, because it could have probably sped up my career even more so than it has been. I look a lot younger than I am, and I won't correct you. So I go on Neil Cavuto. Are you guys familiar with a TV station called Fox Business? So there's a legendary broadcaster named Neil Cavuto, and I'd go on his show as recent as a couple of months ago before he retired, and he would always say, "This young man is the smartest guy I've ever seen." And I just said, I don't correct Mr. Neil Cavuto. He's an absolute legend, but I'm not much of a young man. So we want to talk about the fundamentals of value investing and some of the edges that I've developed over the years. As Cork was saying, I run my own firm. It's called Great Hill Capital. His AUM numbers, he's projecting into the future. We're not quite that big at this point, but we're going to get there for sure, the way things are going with performance and with everything we've been able to build. Prior to that, are any of you old enough to remember the movie The Big Short? It was with Brad Pitt. It chronicled the housing crisis. So prior to going on my own, I worked for one of the firms featured in that movie called Cornwall Capital. They were one of the few who got the housing crisis correct, made a tremendous amount of money on that trade. And then before that, the first fund I was at was a fund called Bedford Oak Advisors. And the principal of that firm was a man named Harvey Eisen. And he was friends with Warren Buffett for 40 years. So I got to learn and cut my teeth in the value investing philosophy. We would fly out on Mario Gabelli's jet every single year, and that was exciting for me. I was, late 20s, early 30s, going on a private jet to the Berkshire Hathaway annual meeting, as I like to say, off to see the wizard, the wonderful Wizard of Oz, which was Warren Buffett. And those meetings and those Berkshire annual meetings really, and the mentorship of Harvey, laid the foundation of my investing philosophy, and it completely changed my life. And for a couple of you in this room today, you're going to hear something or see something and you're going to say, that makes perfect sense to me. And then you're going to read a couple of books and you're going to get some experience, and you're going to wind up becoming very, very successful investors. And I will say, it's a lifestyle second to none if you love it and you learn the few principles that will set you apart. So our philosophy in a nutshell is kind of unpopular these days. Right now, everyone wants to chase the shiny objects, which crypto coin, which NVIDIA, which Trump coin, Melania coin. I mean, there's all kinds of crazy things. And that's a sign of froth in a market. And these are the type of areas oftentimes you want to avoid and stick to basic principles. We make our money buying on weakness and selling on strength. What you're seeing in the marketplace right now, due to recency bias, is people are buying those things that are popular in the news today, that are already up a lot, hoping that someone comes in behind them and pays more for the asset, even though the intrinsic value is not there. That will work until it doesn't, and when it ends badly. Our confidence to step in when others are bailing is rooted in deep research and the premise that the more price becomes dislocated, the more risk has been removed. We're going to talk about a company today called VF Corp. And VF Corp owns a few brands you might be familiar with. Anyone wearing Vans today? Anyone? Okay, we've got huge opportunity for turnaround. How many of you were wearing Vans 2-3 years ago? Okay, all right, so the trend hasn't come back to La Quinta High School yet. How about North Face? Okay, pretty much everyone's wearing North Face. How about Timberland? Okay, we have our, okay. How about, do you have a backpack? JanSport, Eastpak? And you carry books around? Okay, so VF Corp owns all of that. And the cool thing about investing is you can learn how to invest in things that you know and make a tremendous amount of money doing it, particularly if you do it for other people as well over time. So a lot of times when most market participants see volatility as increased risk, we view it as increased opportunity. Okay, when a stock is down a lot, what do most people say about that stock? Don't invest in that stock, it's risky, right? Okay. However, if you pick up a few skills that we're going to talk about here, and you actually learn to see under the hood and see what the business is worth, sometimes those dislocations in price are opportunities in a lifetime. And what we try to do is we look for businesses that are marked down sometimes 60%, 70%, 80%, that we can make 2, 3, 4 times our money in a few years of that stock. Would you guys be interested in making 2, 3, 4 times your money from time to time? Would that be valuable? Okay. Okay. So it's interesting. Did the clap light go on or something? Because something, you know, I heard that this is a caffeine-free campus. We might have to change that, ladies and gentlemen. I know you just had lunch. The philosophy of our firm and what I learned from Warren Buffett and from my first mentor is great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock to be misappraised. I have an apartment in New York City, a place called Bryant Park, 40th Street between 5th and 6th. And I was walking back from the Fox studio after doing a hit, and my doorman said to me, I think Bitcoin had just hit $100,000. And he said, Tom, oh, I saw you on TV, you were great. He goes, should I buy Bitcoin? And I invest in stocks, and I have no view on crypto either way. I said to him, let me ask you a question, Terry. If you put all your money into Bitcoin tonight, and you walk up tomorrow and it was worth 0, would you be surprised? And he looked at me and he goes, if I'm being honest, probably not. I wouldn't be, I'd be disappointed, but I wouldn't be surprised. I said, okay. I said, how about this, Terry? We're here close to Anaheim, California. I said, Disney's stock price is down about 55% from its recent high. 55%. If you put 100% of your money into Disney stock down 55% and you walk up tomorrow and it was zero, would you be surprised? And he said, I would be shocked. And I said, well, that's exactly how we manage risk. So when you get an opportunity to buy a high quality asset like Disney, okay, does everyone love Disney here? Okay, Anaheim, California. How many of you have been to Disney more than once? Raise your hand. Okay, a lot more of you than wear Vans, that's for sure. Twice, 3 times. This is never going to change because the way it works is if you're a parent, and I've got 2 daughters, 10 years old and 12 years old, and you don't take your children to Disney at least once, social services comes to your house and they remove the children from the house and they say that you are not a fit parent. You're abusing your child by not bringing them to Disney. This is the American way. It's always been that way. It's always going to be that way. But Disney has run in cycles for many, many years. In 1984, the stock also fell over 55%. The Bass family, which is a large, wealthy oil family from Texas, bought a controlling stake in Disney, made about 5 times their money over 10 years, made a few $1 billion doing that. And the reason that Disney had fallen so much in the 80s is very similar to the reason it had fallen so much recently, is they had to find a new way to sell their legacy IP library, their content library. And back in 1984, they were transitioning to something called the VHS cassette. No one here is going to know. Does anyone here know what a VHS cassette is? Oh my goodness, okay. Okay, so that's, what do they call that, retro guys? Okay, so they figured out that they were going to take the content library that had proceeded for 20 years and put it on this device called a VHS tape. Stock was down. They're like, that's going to cost too much money. That won't be profitable. Sounds very similar to what? The transition from DVDs to streaming. And for the last few years, Disney lost money streaming. Now they're starting to make money, and the stock is going to double over the next few years. Again, all this is opinion, not advice. Thanks for putting that together, Mr. Snyder. So that's that. Now, how many of you actually are interested in stocks and making money in the stock market? Quite a few of you. Okay. How many of you have tried your hand at day trading? Okay. How many of you prefer investing over day trading? Okay. So I've got the right audience. This is very good. So how does value investing work? I mean, the concept is very simpler, and what's easier said than done is to buy low, sell high, and investing with a margin of safety by purchasing stocks below their intrinsic value. You know, it's interesting, with Disney, for instance, down 55%. Do you think their revenues fell 55%? No. Okay, did their cash flow temporarily impaired because of the investment in streaming? Yes. But on balance, we see these normal cycles that repeat over and over when you buy long-term durable businesses that have lasted decades, and you can buy them during these cyclical troughs and sell them when everyone gets excited. In 2-3 years, you're going to remember this. You'll be in college. Everyone will be like, have you seen Disney stock? It's up like 100% in the last few years. Should I buy Disney stock? My doorman will be coming to me in 3 years and be like, you know, Disney's now $250. Should I buy Disney stock? I'm going to say, no, we had that conversation like 3 years ago. You should have bought it then. Let's talk about something else that's down a lot. So we seek high quality companies that are temporarily out of favor. Some things that are down a lot deserve to be down and may be going out of business. And your job as an investor is going to be to figure out which ones are quality businesses that are temporarily impaired and which ones are actually permanently impaired. Maybe they've been disrupted. Maybe they don't have a competitive moat. Maybe their technology is no longer relevant, which is why we tend to avoid most technology stocks. We learned that from Buffett, because you can get disrupted in a heartbeat because the barrier to entry is very low. And then this strategy, when you're buying stocks with low, and I'm going to emphasize this word, normalized price to earnings ratios, normalized price to book, price to cash flow. Good, I saved that. Don't know where that went. This favors reversion to the mean, okay? And how many of you know what reversion to the mean is? Any statistics, Adrian? Who wants to throw out a broad definition for us? How about you? Yeah. Yeah, that's absolutely right. Yeah. Give him a hand. By the way, the company that owns Vans and Timberland and North Face, how long do you think they've been in business? Any idea? Any guesses? When do you think they started? 1899. Here's a smart guy right in the front row. So they've been around for 120 years, trading in and out of different portfolio brands. That's the type of durable business that over time, if you can buy it, it was down 88% after the last cycle. Why? Because they loaded the channel with Vans. All of you probably have 2-3 pairs of Vans in your closet from 3 years ago. That's all getting worked through. And then the next cycle will come back. And probably your younger brothers and sisters are buying what? The new school Vans, which have the puffy thing on the side, and they'll come back and it'll be another thing. Growth investing varies from value investing in that growth is more chasing the shiny objects, betting on the future, trying to predict the future. I can tell you that I've been around for a while and I've seen a lot of money made and a lot of money lost. There are a lot more people, certainly if you look at the Forbes 400 list, there's only one guy on that list who has made it as a growth investor. But there are probably a couple dozen value investors on the Forbes 400. And for those of you who think Musk is the wealthiest guy in the world, he is, and he's absolutely changed the world. But Buffett, I mean, I know he's only worth 150 billion, but what people forget is he already gave away half of his wealth to charity. So if you add that back, Buffett's done pretty well following a simple strategy, buying things like Coca-Cola Company, buying things like American Express, buying durable businesses that last through cycles. So growth, you're chasing the NVIDIAs of the world. If you remember June 20th, there was a picture of, how are we doing on time, Corey? 45 minutes, okay. So June 20th, there was a picture of Jensen Huang signing for the whole thing, including Q&A. Okay. Signing someone's, I don't know the right way to say it, bikini top, let's just put it that way. Like he was a rock star, like he had that level of fandom and that level of euphoria. And the minute I saw that level of excitement, I put out an article on my website, hedgefundtips.com, which said the next pain trade. Okay, and I didn't get the timing right. It went from 140 to 153. And then I went on Stuart Varney's show on Fox Business and I said, there's a story of Icarus. Icarus flew too close to the sun, and what happened to the wings? The wings started to melt. And I said, the good news is his wings haven't started to melt yet. The bad news is competition is coming. And we're starting to see that. And what happened in the past week with AI? DeepSeek. Competition's coming. They can generate similar type of models, similar type of returns with much more inferior chips, and that's just the beginning, which is going to be good for humanity. It's probably going to be a little bit of a headwind for NVIDIA, and NVIDIA was pricing in great things. NVIDIA will do great things, but price is what you pay, value is what you get. So what we try to do is distinguish facts from reality. So right now everyone thinks if I can just pick the next Tesla, if I can pick the next NVIDIA, if I can pick the next et cetera, I will do better than everyone else. If you go back to 1927, value has outperformed growth, the strategy of buying low and selling high versus buying high and selling higher, by 4.5% per year for over 100 years. Only in the last 10 years has growth outperformed value, and part of that was a function of zero interest rate policy from the Fed, which is no longer going to persist. We're moving to a more normalized rate environment. So unless you believe rates are going back down to zero, you want to look at the long-term data, which favors, and write this down. If you remember nothing from that tall guy who came to your high school class 5 years ago, when you buy high quality assets at good prices, good things tend to happen. If that's all you remember from Tom Hayes for the rest of your life, buy high quality assets at good prices, good things will happen over time. That is the most important message. And this proves it. So let's say you set aside a certain amount of money every single month, like you hear about, to retire, you put it in the S&P 500. All this means the 4.5% a year doesn't sound like much. What it means in real terms is over that time period, your money would have doubled 4 times more if you were invested in value than if you were invested in growth. Okay? So instead of getting to 2, you would have got to 4, to 8, to 16, to 32. You'd probably have 32 million more if you just pick the right strategy over the long term than if you were chasing the shiny objects and getting hit by buses when the fever breaks. When we're buying things down, I'll cover a couple of things here. We tried to do solvency risk analysis. So key thing is, we did a simple example about Disney and VF Corp. Are they going out of business? Because if a stock's down 80%, there are people in the market that think that company is going out of business. So you have to look at the balance sheet. You have to look at their cash flows. You have to look at their revenues. And once you can get confidence they're not going out of business and they have runway, then you start to look, does the business have a moat? Does it have a competitive advantage? How's management? In the case of VF Corp, they got a new manager named Daryl Bracken. Okay, Daryl previously ran a company called Logitech. Are you guys familiar with, or Logitech? Do you guys, any gamers in the room? Okay. Logitech makes this little simple thing called a mouse, and they make this other thing called a camera. Are there any other companies besides Logitech that you can buy a mouse or a camera from? It's like unlimited, right? It's a commodity product, but Bracken is a special manager. Bracken came in as the manager of Logitech, the CEO, when the stock was down 82% in 2013. Over the next 7 years, he turned the company around. The stock went up 26 times. Now, Logitech was not curing cancer, okay? What they were doing was selling little plastic mouses that anyone could manufacture in China. They had these little cameras, but due to his management, his positioning, etc., if you had invested $100,000, that would have turned into $2.6 million in about 7 years. Is that pretty impressive? So when he came into VF Corp and the stock was down 88%, down from some $90 down to $13, $12, $11, we got extremely interested in VF Corp because number one, we had done the solvency analysis, we had done the moat analysis, we had the management catalyst, and then near-term catalyst was Bracken Daryl taking over. Our basis was $15 and change. It got up to $27 recently, and it's just getting started. So we'll probably make 3 or 4 bags on that 3 or 4 times over time, and that's all we do, rinse and repeat. 2 things that give us an advantage over our competitors. Number one, time horizon. We take a long-term view. Our average holding period is 1 to 5 years. I know that's not fancy nowadays. It's 1 to 5 minutes if you follow TikTok. They want you in the afternoon with 0-day options and out by 4 p.m. That gambling, sooner or later, always catches up. There will be one out of a few million that makes some money, but they always give it back to the casino. So just have patience. You'll see how that works. And then the temperament is the ability to drown out noise. A gentleman asked me earlier today, like, don't you watch your portfolio? You've got tariffs today and all that stuff. And the answer is, I know the price that we're getting out of a company before we even get into a company because I've looked under the hood and done the fundamental analysis. And we're going to talk about some things to take advantage of that. We started to cover VF Corp. I wanted to cover a few names with you here. That's Bracken Darrell, by the way, and he did a couple of things straight out of the gate. Number one is he took bankruptcy risk or solvency risk off the table the minute he came in, and he sold off the Supreme brand, okay? Is the Supreme brand going up or going down? Down, okay? So he sold it for $1.5 billion. He sold it to pay off debt, and now their solvency risk is no longer off the table. He can focus on turning around Vans, which is improving sequentially. The improvement starts in Europe, it starts in Asia, and then eventually it'll get to the US. Watch, within 1 to 1.5 years, I'll bet when I ask who's wearing Vans, probably a third of this room is going to raise their hands again. It's going to be like 2000. When did you all own Vans? 2021, 2020? Is that basically when they were hot? Yeah. 1982? That's a durable brand? Yeah. Yeah, and they've still got the building there on the highway I see when I drive the girls to Irvine to swim. So that's a big thing. North Face is a no-brainer. Everyone wears North Face. It's huge in Asia. And by the way, they're going to benefit immensely from the turnaround in Asia, okay, as China comes back, which is starting to a lot of stimulus over the past 2 years in fits and starts, and now it's all starting to come together. So we think this can, short-term conservatively probably move up from, it's moved up from 15 or 13 to 27. We think it goes to 40. And then from there, we'll look and see how the execution is, what the fundamentals look like. But I was listening to Bracken after last week's earnings, and I think he's going to run this thing back up to new highs, and it's going to take a few years, and he's going to build an incredible franchise, and he's an incredible leader. Second one, Alibaba. Has anyone ever heard of this company? Oh, a lot of you. Okay, good. So Alibaba is basically the Amazon of China. And the most important thing you need to know about this, because we're going to want to open for about 30 minutes for questions. Is that?
Yeah. Maybe go for 10 more minutes and we have like 15 minutes of questions.
Yeah, okay, great.
I'll let you know.
What do you guys like, lectures or questions? Questions? Okay, good. So lecture? Questions? All right, hands up if you like questions. Hands up if you like lectures. And the rest of you are probably in the lecture camp because you're sleeping. No, I'm kidding. All right. So this is a perfect example of price is what you pay, value is what you get. So during the COVID surge, the stock hit just over $320 per share. And post-COVID, it dropped down to about $58 a share. Okay, so more than, how much of a drop is that? All the math whizzes in here. 320 down to 58. You can ballpark it if you want. All right. All right, let's call it over 80%. We love the 80 round number. So it's like, why would the price drop 80%? I mean, if you saw this stock chart and someone said, I got a great stock for you, and you looked at the chart, what would you say to them? I mean, the thing has fallen. It looks like it's gone out of business. Is that correct? Okay. Do you think most people, if you walk down the street and show them this chart, would say, yeah, that's a stock I want to buy? No. Okay. So let's talk about what's happened in terms of financials over that time period. If you look back, the company IPO'd in 2014. Back at around these prices, it was around $88. So that's all the way on the left side of the chart as you guys are looking at it. Since then, price is basically around the same. It started to rebound off the bottom. It's around $100 now, but it's basically trading for the same price as it did 10 years ago. The difference is revenues are up close to now 10x or 1,000%. Earnings and cash flow are up about 6x or 600%. So you're getting 600% more free cash flow, and all that really means is money left to you as the owner of the business, because if you own one share of a company, you are an owner of the business for the same price. And these type of divergences between intrinsic value and price are where fortunes are made. There's no other surer way, in my view, candidly, to make insane amounts of money than buying high quality assets when they're temporarily out of favor. There's nothing like it. Like if you were to walk into the board of this company and say, I will buy the entire company at the price that it is quoted in the public markets today. I'm financed by JP Morgan and I'll put up some equity on my own. Will you sell me the company? They would call security and have you removed from the building because they would think you were absolutely lost your mind. They would think you're crazy. And yet, every single day in the public markets, prices react so extreme to the short-term headlines, to the short-term noise, to the short-term fashion show, okay? Like certain clothes go in favor, out of favor. Certain stocks go in favor and out of favor, unrelated to the underlying fundamentals. So if you don't wear Vans today, forget about the fashion because no influencers are ramped up yet. We'll get the influencers going. It's going to happen in about 12 months. Do you think the quality of the Vans product is good? Like when you wear it, is it durable? Or is it garbage and it falls apart? It's durable, right? It's a good quality thing. It's a reasonable price. It's just temporarily out of favor. That's what the sneaker is. It's the same thing that's happening with the stock. And then all of a sudden, you're going to see in 9 months, 12 months, my girls are 10 and 12, let's see. Sabrina Carpenter is going to put on a pair of Vans, and half of this room is going to buy a pair of Vans. She won a Grammy last night, right? You guys watch you guys only do statistics up here? All right, good stuff. All right, so Alibaba is basically the Amazon of China, and it's effectively an AI ETF in China. So if you want to own a piece of every single AI startup in China, you want to own Alibaba. Why? Because they give startups compute power. They give them cloud services for free, tokens in exchange for equity in their company. And most people aren't aware of this, so it's not priced yet into the stock. But when you see things like Quinta 2.5, their model actually beat DeepSeek. They put out the data last week. That's why the stock is up. That's why it's just getting started. So any of you play poker? Yeah, so a lot of you, good. So in poker, there's something known as outs, okay? And in Alibaba, we have a lot of outs. Number one, it's the number one cloud provider in China. Number two, it's the number one retailer to the middle class. So in the last 2 years when the economy was down, who did well? The companies like Temu selling the cheap junk that no one really cares. You buy it all and then you never use it and you put it under your bed. Alibaba caters to the middle class and the upper class. The higher end luxury brands are all on Alibaba's platforms. You have Taobao, you have Tmall. International business is growing 30, 40% like a weed. And their AI model is faster than OpenAI. It's faster than DeepSeek, and it's just beginning. And you can buy it at 5, 6, 7 times earnings, which its historic normalized multiple is like 25 to 30 times when it gets back into the fashion show and people get excited and Sabrina Carpenter starts wearing Vans and all that stuff. So these are the type of things. So this one, it's trading at about $220 billion market cap. It's got $70, $80 billion of cash and 5, 6, 7 times earnings. That doesn't exist. You compare that to something like NVIDIA is trading at 50 times earnings. So price is what you pay, value is what you get. You can pay a lower multiple for more earnings with something like Alibaba, or you can chase the shiny object and get your face ripped out like NVIDIA's down 24% in the last few weeks since DeepSeek. Couple tips, anyone looking to get into the investment business, hedge fund world? Okay, about 10, 20 of you. Okay, so I would say a couple of things. MBA can help. I think CFA is more important if that's the route you want to go. I think certainly a statistics background is useful. You got to have math, you got to have accounting, finance, economics. We've got basically all those teachers in here. And for me, I would say part of the reason that I'm here doing this speech is because a guy named Warren Buffett was generous enough to share his ideas. If he wasn't so generous with the population and sharing his ideas, I wouldn't have a career and I've been able to build an amazing life for my family, for myself, for my clients, as a result of the principles that he taught and the principles that he learned from a gentleman named Ben Graham, who wrote the book, The Intelligent Investor. And my best suggestion to everyone in this room is read the book, The Intelligent Investor by Benjamin Graham. And one of two things is going to happen. Either one, a light bulb is going to go off and it's going to change your life and you're going to go on to become an incredible investor over time, make all your dreams come true. Or number two, you're going to say, I didn't really understand what that Ben Graham was talking about in 1923 or whenever he wrote the book. I'm not interested. And then you're going to go off and become an entrepreneur and create things that are going to change the world. Either way is a great path. I'm very grateful for the path that I got into, partially by accident, and I hope that makes a difference. But I think that's one way to kind of get some education. If what you read in that book sets a light off, I would suggest you read every single annual letter Warren Buffett has written since he started managing money in the 50s. And those lessons, and I've done that, will absolutely almost guarantee that you will be a successful investor over time, because no one does it. You'd be amazed the amount of money that's managed by people that don't know basic fundamentals and basic principles that Ben Graham started, Warren Buffett implemented, and there's probably a couple hundred people around the world that implement those principles well, and you know who they are by their results. So with that said, let's open it up for some Q&A.
Okay, so if you have a question, come on down here on the line, okay? Come on over here. Okay. Okay, here we go. This will be good. I'm a little nervous. Go ahead.
What investors should you make? What's your story?
Yeah.
This is your emotion.
Yeah.
What stocks would you recommend?
Yeah, I think that's a great question, by the way. Give her a hand. I think the number one thing you can do at any age, if you're just getting started investing, is decide every single month that you're going to pay yourself first. And you're going to set aside, whatever it is, $200, $400, $500 a month, and buy the S&P index fund or the VTI Vanguard All Market ETF. Low cost, it'll give you exposure to the top 500 stocks, and just do it every month, because when the market's high, you will buy less shares automatically. When the market's low, you will buy more shares because it's the same amount of money, and that will compound over time. And then that gives you the runway and the security of savings where you can start to learn about individual stocks and maybe start to outperform over time as you enjoy that. But that's probably the best advice I would give. Although it's all opinion, not advice.
How much money do you make?
I will say, I will say, first off, it's a reasonable question. It's the wrong question. How? No. So the right question is, how much are you worth? Okay? So how many of you have read the book Rich Dad, Poor Dad by Robert Kiyosaki? Okay, that's a life-changing book. That's a book that you all need to read, because I grew up poor, like lower middle class. So when I was 10 years old, I had a paper route. You don't even know what that means, but you delivered these physical things called newspapers to people's doors and asked them for money. I was a dishwasher from 11 to 12. I was a golf caddy from 12 to 17. And when you grow up poor, the only thing you think about is, how much money can I make so I can buy some piece of bling or this or that? Once you get rich and you have done that, then all you think about is, what assets can I buy that generate more cash, that continue to build more wealth, et cetera, et cetera, et cetera. So you're thinking less about ordinary income, and you're thinking more about investments that generate cash that can pay for everything that you want over time. So I'll leave it at this. it's beyond anything I could have possibly ever imagined. I didn't plan it. I was always ambitious. I was always willing to do the work. But I think the best answer is I make 75% less than my clients make. Because in order for me to get paid, they've got to make money. And the way my business is set up is if they don't make money in a given year, how much do you think I make? 0. We have no management fee. 0. Only performance fee. And we set it up that way because we simply copied what Warren Buffett did when he was managing outside money. We don't believe we should get paid for watching people's money. We believe we should get paid for results. And once you think about how much value can I deliver to other people, you will get more money than you could ever possibly imagine. So whoever asked that question, and it's a good question. And the other thing is you'll get to a point when you don't have to work anymore. Then it's about freedom. 2, it's about making a contribution. And 3, if you're an athlete, it's honestly about competing and winning. Like there's a real joy in doing the best work you are humanly capable of. And I hope you maybe have that a little bit in your school studies right now. It's not just like, oh, I got to get good grades to get a good job to make my parents happy. It's like, no, let me see what is the best I can possibly do given the genetic lottery that you won to be here in beautiful Southern California. I mean, you could have been born in Bangladesh with no food and no water, right? Instead, you got born, somehow you were born in sunny, beautiful California in America with a beautiful school, with teachers that care about you enough to call this guy for 3 months to say, come speak to my students. We don't realize how lucky we have it to be born where we are and have the opportunity. So, a lot. All right, good.
Do you follow Statman on TikTok? And what do you think about TikTok?
First thing is Statman. Of course I follow Statman. Who doesn't follow Statman? Everyone follows Statman. What was the second question?
What was the other one?
And what do you think about his TikTok?
I'm still trying to understand the lessons. One of these days I'm going to understand statistics so well I can really make some money. But for now, I'm learning every single week I listen to his lessons. So next question.
How big is your house?
Which one?
You said you didn't come from a lot of money. What's going to be some advice you give to our generation?
What you lack in capital, you can make up in labor. So what I decided at 10 years old, I was just going to outwork everyone around me. I mean, the one thing that my parents did right, and they did many things right, was they believed in education. And they pushed me to go to school even though I didn't want to, but everything that I wanted to do for myself, I had to earn. And I would just embrace work. I think being a golf caddy was the best thing that ever happened to me because I realized at a very young age I never, ever want to have to do manual labor. I want to get paid for my mind. And I learned that at a very young age. And a lot of people coast through the cool kids in school and all that stuff. And you'll be shocked. All the people that you think are going to be the stars of real life, that are the stars right now, are going to be working for you. So when people are tough on you and et cetera, just use it as motivation to work harder, become better, pursue your dreams, and no matter how many times you get kicked in the face and you fall down, get back up one more time. Good question.
Can you study the difference between momentum investing and turnaround investing?
What's the second one?
Turnaround investing.
Yeah, that's a great question. We tried to cover it a little bit. So momentum is kind of chasing things where the price has gone up a lot, not necessarily grounded in fundamentals. Oftentimes, high price to sales multiple, earning little to no money, but everyone thinks it's going to be the next big thing. By the way, Amazon.com in 2000 was trading similar to like how an NVIDIA was today. Everything that people thought Amazon was going to do, it actually did. The problem was in 2000, you were already paying the price for what would happen eventually 15 years later. You know, on an app, stuff comes to your house the next day, or if you're downtown Huntington Beach, it comes to you that day, or in like an hour. It's crazy. The cloud computing, all those things. So what happened? The stock ran up because all these great things were going to be happening. Everyone was right. All the great things happened from Amazon. Everything we thought they could do, they did and more. The difference was they got too excited too early. The stock fell 92% from 2000 to 2003, even though the fundamentals of the business were improving, very similar to what's happening with Alibaba now, before they recovered and went on to do great things. So you can be right about the narrative, but if you pay too much for an asset, you're going to get hurt. And so what we try to do is take the opposite side, invert, like Charlie Munger says, and say, well, if that's what's going to hurt you the most in business, what's going to help you the most is buying a great quality asset when no one wants it, and then riding it back up. And that's what we try to do and play the mean reversion over time. Great question.
What was the biggest break in your career when you were younger?
Biggest what?
Biggest break in your career?
Oh, biggest break. Probably meeting, well, I think the biggest break in my life was probably marrying the right woman. Yeah. Yeah. Because that's probably the most important decision you'll make in your life, by the way. Because I was willing to take risks, and she was never like, oh, if we do that, what if we lose this? What if we lose that? She was always like, try it, we'll figure it out. Try it, we'll figure it out. So I never had that like nagging, like, what if this, what if that? She was always just willing to be like, let's go for it. And I think that's number one, pick the right partner. I would say my first hedge fund boss was, taking me into that value mafia world, bringing me around to the meetings, the hedge fund lunches with Lee Cooperman and Mario Gabelli, and the annual meetings with Warren Buffett. That was life-changing and kind of just learning by immersion. He never really sat me down and said, learn this, learn. I learned by immersion, and I had to self-generate the motivation because he was already very wealthy. He didn't have the motivation to train an analyst and everything else. So I think that was a break. I would say the other advice I would give that took me longer to learn was, hard work and effort and persistence, and smarts, that's kind of table stakes if you want to perform at the highest levels. The quantum leaps, if I have to look back, happen in the social circle. And that's hard to understand. So 2 things I would say about the social circle. Number one is hang around with people who are better than you. If you want to be a better golfer, play with better golfers. If you want to be smarter, hang around with the smartest kids. If you want to be faster, swim with the fast. I'm in here in California because this is the best water polo in the world, and my girls are serious about water polo and swimming. So this is where they need to be. They got to be around the fastest people because being number one in, wherever, that doesn't matter, is not going to help them. So I think you have to, I'm not social by nature. Once I realized that all the quantum leaps in my life came as a function of the social circle, I forced myself to be in situations around people who are smarter than I am, better golfers than I am, wealthier than I am. Not to climb, it's just to become the best you can possibly be in whatever you're up to. If you want to become a fashion designer, don't hang around with people that have no fashion sense. That's really what it comes down to. If you want to be a fast track star, run with the fastest kids so you feel like you're slow. Don't run with the slowest kids so you feel like you're a champion, because you'll never get better that way. Yeah. That's hard. I would say, econ is a good major. Business undergrad is a good major. if you're going to go to business school, I would go to, if you want to get into this, I'd either go to, if you can get into Columbia or if you can get into Wharton for business school, if you want to be an investor, those are probably good places. But honestly, the CFA designation, you can study on your own. You probably have the books in your library, and if you don't, you can get them at the public library. Start to study for the CFA and educate yourself. Formal education will make you a living. Self-education will make you a fortune. Anyone who's achieved things that you think you want in life, they're exceptional. Yes, they know the basics that you all learned in college, but they developed an edge or a method or a way of doing things from experience and from self-study, from self-learning on top of the basic learning that really pushed them ahead. So yeah, I've seen it. I've seen everything. You know, it could be English, it could be history. You learn how to write and communicate, and then you take the CFA on the side and you develop skills and that type of thing. But I would say accounting is the language of numbers. Very important. I know there's an accounting teacher in the back. Econ, business, all fine. Have some statistics courses and that type of thing. Yeah, thank you.
We got probably time for about one or two more, okay?
How do you use AI for your job?
Good question. It's currently not at the level I want it when I ask it the questions I want it to answer, but it will be, and I'll use it more and more. I mean, for me, the number one thing is I'm not interested in second-hand interpretations of analysis on the assets I'm looking at. I want source materials. I want public company materials, and I draw my own conclusions. And some of that comes from experience. Simple answer, I need to get better. Second simple answer is so does the technology. But yeah, I'm going to explore that with you. I mean, right there it tells you why the playing field is leveling. And if you can master some of these things, you can disrupt things that have been in place for many, many years. So get after it. You'll do great.
Okay, last question.
What role have relationships and connections played in your life?
Yeah, this I learned later in life. I think it's probably the most important thing you can do other than table stakes. Learn the skills and invest. So I would spend a lot of time doing that and do it with people who make you grow and people who want to see you succeed and people who push you to be better. And if you're focused on that, I think the sky's the limit. So yeah, great question.
Okay, I want to thank a couple people, Mr. Goals, Jennifer back there, and company back there. Thank you very much, Mr. Goals, and of course, Mr. Thomas.
Thank you.